What is a bear market? Let's be honest. The world of investing is accompanied with lots of complex terms and business jargon. One such term is what is called a bear market. So stay tuned as we delve into what it means, the causes, and how to profit from a bear market. Two investment terms that frequently get thrown around, whether you're looking at cryptocurrency, stocks, real estate or any other assets, are bull and bear markets. While both are used to explain how markets are behaving, they are very different in terms of the influence they can have on your portfolio and investment decisions. So, what precisely is a bear market? A bear market typically refers to a situation when a broad market index falls by 20% or more from its most recent high due to widespread pessimism and negative investor sentiment. While 20% is the threshold, bear markets frequently fall much deeper than that over time rather than all at once. Individual stocks, as well as markets as a whole, such as the Dow Jones Industrial Average, can undergo bear markets. The Great Depression was the first and best known example of a bear market. Other examples include the dot-com bubble in 2000 and the housing crisis of 2007-2008. The term bear stems from the idiom, selling the bearskin before catching the bear. Therefore, it refers to an investor who expects prices to fall and sells a borrowed security or commodity with the goal of buying it back later at a lower price, a speculative transaction known as short selling. The opposite of a bear market is an upward trending bull market. How long does a bear market last? Many investors are worried when they hear the words bear market. However, deep market downturns are unavoidable and are mostly very brief, especially when contrasted to the duration of bull markets. Bear markets last an average of 363 days shorter compared to the 1742 days average for bull markets. According to evidence, they are also less statistically severe, with average losses of 33% versus bull market average returns of 159%. The coronavirus bear market, which began on March 11, 2020, lasted for only 33 days before quickly transitioning into a bull market. How do bear markets occur? A bear market can be caused by a number of factors, including a bad or lagging or slow economy, bursting market bubbles, pandemics, wars, geopolitical crises, and substantial economic upheavals, such as the transition to an internet economy. Bear markets frequently occur just before or after the economy enters a recession, but this is not always the case. Investors constantly monitor important economic indicators such as hiring, wage growth, inflation, and interest rates to determine when the economy is weakening. What are the phases of a bear market? Bear markets typically have four distinct phases. The first is recognition. It is distinguished by high prices and strong investor sentiment. During this stage, investors are prone to mistaking the onset of a bear market for normal day-to-day fluctuations. The second phase is capitulation. In this phase, stock prices begin to decline significantly, trade activity and corporate profits begin to fall, and previously optimistic economic indicators begin to deteriorate. As sentiment begins to deteriorate, some investors begin to panic. The third phase is stabilization. Here, panic selling begins to subside, and investors begin to digest the reason for the price drop. The stabilization stage is the most tumultuous and unstable of the three. As market speculators enter, rallies may occur. In the fourth and final stage, stock values continue to fall gradually. As low prices and good news begin to entice investors again, bear markets begin to give way to bull markets. What to do in a bear market? Bear markets are part of the economic cycle, and armed with the right knowledge, you can make the most of them. Let's look at a few top strategies to consider in a bear market. 1. Short selling. Short selling is one of the top ways investors can make profit during a bear market. It involves borrowing securities, then purchasing them at a cheaper price, and returning the securities to the lender. The difference between the price at which the shares were sold and the price at which they were bought back, referred to as covered, is the short seller's profit. However, it is a high-risk trade that can result in significant losses if it fails. 2. Dollar cost averaging. Dollar cost averaging is the process of investing money in about equal quantities over time. This helps to balance out your buying price over time, ensuring you don't invest all of your money in a stock at its peak. 3. Diversifying. Another top strategy is to diversify your holdings, invest in sectors that perform well during recessions, and make an effort to focus on the long term. There is no doubt that bear markets might be frightening, but the stock market has shown that it will eventually recover. Therefore, it can be a fantastic opportunity if you adjust your mindset and focus on prospective gains rather than probable losses. You still don't know everything about finance. Believe it or not, you can find more information you need in this video here. Knowing all these, are you still scared of bear markets? Leave us a comment below.